We will start in a minute, okay? Let me see the chat. Good morning to everybody. I see that you started immediately with questioning, and that's okay. Two members of the group will present on WebEx on 5th November. Hello, Valeria. So the formal decision about the group presentations, I know that many of you have a problem to come in presence, but what we have decided is that if you are going to take the exam online on 9th of November, then you can also present online on 5th of November. So make sure that you cannot really come. As I said, we are encouraging you to come in presence for the exam and for the presentations. So there is no problem if you are also taking the exam online, okay? So we want to organize the two different events, presentations and exam. And therefore, if for the exam you are also going to take it online, then the presentation will be online as well. Valeria, I know that probably I also communicated with email. I'm not sure if I'm right about that, or there is another student named Valeria. But this is what we are going to do, okay? So whoever is going to take the exam online is also going to present in WebEx, except for the students to which I have already communicated the decision, okay? I can see that. Valeria, did you question me through email, or I am wrong? I guess you sent me an email a couple of days ago and I said that I will come back with a decision for you, right? So let us continue our communication through email. I know there are a lot of problems like that, but please be advised to make the necessary appointments and plans, okay? So let's continue that discussion in email, and let's have this time now for discussing the chapters. Okay, so if there is any other question regarding the chapters and regarding questions that you might have regarding the contents of our course, you are welcome. Otherwise, if you have problems with booking the swab test, the tampone, then we can discuss afterwards, not to take minutes away from our lecture and to make the other participants participate in this, okay? So as you can see, maybe you have already noticed that we are jumping from chapter 29 to chapter 31. That is, we are not skipping chapter 30. We are just going to discuss it later because it really gives like a theoretical background to all the calculations that we are going to perform in ratios and financial analysis. And because I want you to also have time to practice and apply the calculation of ratios for each of your own companies. This is why we are jumping from chapter 29 to chapter 31 right now. Of course, chapter 30 will be discussed during the lectures next week, and it is also very important to give us like an overview and a contextual background to understand more in depth the figures and the numbers in the financial statements. Okay, so this is why we are making this adjustment in our schedule. Furthermore, I know that many of you have already started calculating the ratios for your own companies, and that is a very good thing. I am really very pleased with many of you that have asked me through email different questions, and therefore I decided to continue with the ratio cover with further chapter, and then we will jump to the theoretical discussion, okay? So probably let's have a look at the learning objectives for today. Something that we are going to learn today is to identify which are potential pitfalls or potential red flags, if we can call it like that, that can hinder us, that will not allow us to really analyze and compare financial accounting data. The problem is that we want to use financial ratios to compare companies together or to see the trend of a company over time. The real problem that arises is that sometimes companies, they really change their figures, they change their amounts and data. For example, in the last chapter, we discussed about Carrefour company. If you notice the financial statements in 2019, there were different numbers related to those in 2020. That is because the company restated their financial statements. Okay, so in case of adjusted figures or restated figures, we have to keep in mind that the company is correcting some financial accounting error, and therefore this will make it more difficult for us to compare the data between years or between companies. So first of all, we are going to talk about what may hinder our comparing information between companies or for a company over the years. So keep in mind that sometimes you have adjusted data or restated data, financial information. And that is a common source of problem in comparing financial accounting information. Another objective is that we will learn to apply some other techniques of financial analysis. As you can see, the title of the lecture today, the title of this chapter, is Techniques of Financial Analysis. That means that there is not only the ratio analysis that we apply. There are also other techniques that we can use, and we are going to learn about those today. The first one is the trend analysis. As the name implies, the trend analysis tries to focus in the trend of different important items from financial statements and understand what do they mean for the performance of the company. For example, in the trend analysis, we will learn how to see the movement of inventory. Has it increased? Has it decreased? And what does that mean? The change in the receivables or the change in the payables amounts. What do they imply for the company's activity? We will certainly notice a very important trend for 2020. I guess most of you, in your analysis of your own companies, will notice that in 2020, most of the companies have a decline in their activity. Total assets have decreased. Total sales revenue have probably decreased because 2020 was a difficult year. So how can we understand and interpret the trend analysis? This is the first technique. Then we are going to learn also about some other technique which is known as common size analysis and sometimes recognized also by the name vertical analysis. In the common size analysis, we compare for a certain year, we compare different amounts, different items with the total of the financial statement in order to understand the structure of investments, financing, the structure of revenue and expenditure. So the common size analysis converts the financial statements from amounts to percentages, thus allowing to have a relative point of view on the activity of the company. Both of these techniques, trend analysis and common size analysis, they are used together with each other to help us interpret and understand the company performance. And then another technique is the ratio analysis. We already discussed about ratio analysis in the previous chapter. So when we cover the ratios today, most of them are already familiar to us. We know about the current ratio, we know about the return on equity, for example. We are going to learn only a very limited amount of new ratios today, but most of the ratio analysis technique you are already familiar to, and this is going to be an easier part for the lecture today. Another point to mention is the segment analysis. We have also previously mentioned the segment reporting and why is that important for a company. Right now, we will have the opportunity to discuss about the importance of analyzing segmental activity and understanding which one is giving the highest income and the highest profit to the company. Based on the segmental analysis, in this session that we have this afternoon, we are also going to mention a short example about identifying reportable segments. So this is something that we are going to cover today. The last thing about the types of analysis or techniques of financial analysis is the cash flow. The cash flow analysis is a technique that is based mainly on items coming from the cash flow statement, and therefore we have this name over here, cash flow analysis. So again, this is some kind of technique that is mainly based on cash flow statement. Cash flow statement is really very important. We emphasized that point already, because it gives us information about cash inflows and cash outflows and helps us to recognize the cash dynamics of a company. And the cash is really important. Sometimes in finance you may have heard the term cash is king. And yes, cash is king because cash allows you to continue operating, not profit, not really. Profit is an accounting figure, whereas cash is the real money that you can use in your activity. And therefore, cash flow analysis is important to understand the past performance and also to be able to predict or forecast maybe the performance for the future. So these are like the 5 types of financial analysis or financial analysis techniques: trend analysis, common size ratio, which we already know what is that, segmental analysis, and cash flow analysis. The 5 of them are going to be covered and explained today. First, theoretically, and then we are going to have a practical example with a real world company. For today, I have chosen not Carrefour company, but I have chosen PSA, a Stellantis company. So we will illustrate all our examples through that company today. So let's continue with the contents very briefly, because I already mentioned them discussing about the learning objectives. So first of all, which are the items or the reasons for having non-comparability in financial statements? What is that makes us not being able to compare financial statements? Then we are going to discuss trend and horizontal trend or horizontal analysis, and then common size analysis, segmental analysis, ratios in connection to the IAS and IFRS accounts, cash flow statement, and the ratios that we can calculate based on the cash flow statement. By the end of the chapter today, we are going to mention, but very briefly, because we will continue in the next chapter, we are going to mention very briefly what are some limitations of ratio analysis. Are they perfect? Of course not. So whenever we use ratio analysis to analyze a company, we should keep in mind the pitfalls and disadvantages and the constraints and limitations of this kind of technique, okay? The very last thing that we are going to discuss about is something very interesting, which is like the trend in the recent empirical research in financial analysis, and that is multivariate. Multivariate analysis really combines together different ratios in order to understand the performance of a company in a better way. So ratios are really univariate. They are being interpreted one by one, whereas multivariate analysis tries to combine different ratios together and calculating some aggregated scores. The most famous one are the Z-score of Altman and M-score of Binesh, and we are going to mention them by the end of this chapter today. The investment perspective is also something that we covered during the ratio analysis, nothing new in that, and disclosure of non-financial data is another topic that we are going to elaborate more later in our next chapters. Therefore, something that I will just mention today. Okay, so let's start with what are the red flags, or what are some reminders for you to understand that sometimes you cannot compare different financial statements because of something that is going on behind the numbers. You just see the numbers, but how they are computed, how they are calculated, that impacts the power and possibility of comparing these items together. So we have to check this prior to actually performing the analysis of performance, financial status, our cash flows, our investments, and so on. So we have to check about potential problems, like we give some examples there. Sometimes companies unexpectedly change the time span of the financial year from 12 months, for example, to 15 months. And that sometimes happens to cover some losses that if they had reported financial statements for 12 months only, it would be a loss. But if they include some other months in this period, they would report a profit, which is preferable and desirable for the companies. Okay, so be aware if the company has unexpectedly changed the time span of the final year. Of course, it can disclose this information and give some arguments and some reasons for that, but sometimes that's not just acceptable. It's not a good reasoning. They are not good arguments to use. So be aware of these kind of situations. Another thing that may cause non-comparability are different reporting dates among different companies. So be aware when you compare a company in Europe. Usually in Europe, we have the accounting year the same as calendar year from 1st of January to 31st of December. Whereas in US, the accounting year usually starts in 1st of April and ends on 31st of March. So whenever you have to compare companies, keep in mind that even though they may be using IFRS, for example, the company in US and the company in Europe, but still they are reporting covering different days or different periods, and that may impact the cyclicality or seasonality of their activities. It depends when they generate the most of their profit or revenue. So be aware of different reporting dates among different companies. Another thing is the change in the company structure. For example, we may have mergers and acquisitions of other subsidiaries or other branches, and that means that the structure has changed considerably. We cannot leave that not regarded. We have to include this information in our analysis. Or SPE over here is special purpose entities. Sorry that it is, okay, SPE, let me explain that in the chat, is special purpose entity. Usually companies introduce special purpose entities to cover or to hide their debts. That is, that in their financial statements they will only report revenue and profit and assets and equity, whereas their liabilities and debts are hidden away in some special purpose entities. So be aware of these special purpose entities. They are disclosed in the notes and financial statements, but for a not attentive eye, we may just miss them and we do not really read the information. Does this company have a special purpose entity where it records losses and debts only? For example, if you may have heard of the famous bankruptcy of Enron Company in US some 20 years ago, the technique that they were using to hide their losses were special purpose entities. They would open this sort of other companies, let's say. They would name them special purpose entity because they would assign to these companies a special operating activity, and they would use these companies to hide away their losses and their debts. Okay, so be aware if the notes in the financial statements have any information about changes, important changes in company structure. Something else that we should be very careful to look at is any changes, if there are any, in accounting methods and accounting estimates. Of course, this means that we have to read very carefully through the notes and financial statements, and that is very time consuming. I accept that. You have already seen that the notes of financial statements are complex, are difficult to understand, and are large. They are like 100 pages long. That means that sometimes when we are not really attentive, we may miss something. That's okay for the purposes of the group work project, but that's not okay if you are in the real world and you are a real financial analyst and you have to perform a financial analysis. You have to be really very thoughtful and very attentive to every disclosure in the financial statements. More about accounting method changes and accounting estimate changes we are going to discuss in the next chapter that we are going to explain in another lecture. Another element, another possible situation of not being able to compare financial statements is when we change the financial standards that we use. The generally accepted accounting principles, the GAAP, may change. For example, IFRS 16 leases and its impact on the gearing ratios. I'm bringing this as an example because a simple change in the financial reporting may change the values in financial ratios without necessarily changing the substance of the financial structure per se. You have already, I think that you have covered and discussed about the leases, right? Just give me a hint here to understand. Have you discussed IFRS 16 in your first part? Okay, thank you. So you discussed IFRS 16 and you already know that whatever lease contract the company has more than 5,000 euro, that has to be included in the financial statements. Either if it is financial or operational lease. That means that if I include every item, special purpose entity, not special purpose, okay, vehicle you can call like that, but the accounting correct term is SPE, special purpose entities. What I'm saying about the leases, by having right now the requirement to include all the assets in financial statements, even those that are rented, are taken with a lease, operational lease, that means that the amount of the liabilities will be increased. And that will have its impact on the gearing ratio. Now remember that what we knew, the gearing ratio, is the same thing as solvency ratio, and sometimes this is also the same thing as a leverage ratio. This word leverage is even more famous to use. So keep in mind that we are talking here about the same thing. Gearing, solvency, leverage, they are the same thing. They are talking about financial structure over here. Whenever I have to report more liabilities just for the sake of reporting and complying with the new IFRS, that does not mean that suddenly I have more debts. It's just that I'm including and reporting more liabilities. It is already a very widely discussed topic that the requirements of IFRS 16 have a considerable impact on financial ratios on the companies. If you are interested to know more, I can provide some more information later for the interested students. And of course, differences in presentation, different formats, layouts. Probably you have already encountered this difficulty in performing analysis. You may have different names for the same thing. For example, I mentioned gearing, I mentioned leverage, I mentioned financial structure, solvency. They all mean the same thing. You may have different names for the same thing or different format and layout. Some items are included before or after. So you should really become familiar with this variety of presenting the financial information. So please be careful whenever you read the financial statements, because sometimes it's not as easy to apply the comparison either between companies or for a company between different years. Okay, having said that, having mentioned the red flags And now we know what to look for. Whenever we do an analysis, performance or financial structure analysis, we know that we should pay attention if there is any of that situation over there that we mentioned. Right now, we can jump to the techniques that we really use. One of the most famous technique is the trend analysis. Why I say famous is that sometimes the companies themselves, they include in the face of their financial statements, they include the trend analysis. If you remember the case of Carrefour Company from last lecture, I copied and pasted an extract of the income statement in the Excel spreadsheet. And if you remember, in the income statement, the company was performing a horizontal analysis. It was comparing items to each other. So sometimes companies really include that and disclose that in the face of financial statement, especially if that is something desirable, something good to show, okay? So what trend analysis basically does is that compares company performance over time. It is considered as a sort of a benchmark. If you remember the three benchmarks that we could use, it was the company activity in the previous year, it was the activities of another company in the sector, it was the budgeted activities, and also the average indicators of the sector. So this is another example when we can refer to the past results as a kind of a benchmark. So we can compare to the previous years. Are we better or are we worse than before? So percentages changes are calculated between two financial years. First, we calculate the change of the amount from one year to the other. For example, the inventory, is it changed, is it increased or decreased from one year to the other? And then we have to, or we can express the above change as a percentage compared to the figure of the first year. That means that the change should be expressed in monetary value, but also in percentage to give us a relative context or a relative background on the importance of the change in itself. Sometimes the change can be millions of euro, but this is really a very small change for a huge company. But the same change in million of euros in inventory for a medium company is a considerable change. So by expressing the change as a percentage compared to the figure of the first year, we may have some relative comprehension of the situation. Something that you should really be careful over here is that whenever you analyze negative amounts, you have to be careful how you calculate the difference and also the percentage. We'll see several cases about that. And also how to interpret the abnormal changes. Sometimes you may find that you have an increase in percentage very huge, 1000%. But that is connected with an item which is really very small amount, and therefore it gives such a high change in percentage. So we have to pay attention not to overestimate these abnormal changes that we are mentioning. Another thing that we can mention in the trend analysis is that whenever we have more than 2 years of data, it is advised to use the trend percentages. So again, I'm writing in the chat, trend percentages are used when we have more than 2 accounting years of information. Now, when I have information about 3, 4, or 5 years, it's not very practical to calculate the difference in monetary value and in percentage from one year to the other, and then from the other year to the other year, and so on. It is better to use another technique that is also part of trend analysis. In the trend percentages, this second technique, we select a base year. Usually the base year is the first year in the time frame considered. For example, if I to analyze from 2015 to 2020, 2015 is the base year. So I compare the activity over 2016, 17, and until 2020 to 2015 and see how the items have changed. So the first step is to select this base year. I will compare everything that's happening in the other years to the amounts in the base year. And then the second step in the trend percentages technique is to set the item amounts of the base year, all of them equal to 100%. That is the base year 2015 that I mentioned. Everything there is 100%. For example, sales, cost of sales, interest expenses, and so on. Then the last step is I compare every item during the other years to the base year and calculate a percentage of the base amount that is sometimes known as an index. And comparing the index with each other, we can understand better the performance of the company, the trend of those items. Okay? So these two techniques, calculating percentage changes and the other one, trend percentages, are used in different situations. Remember and write that down. Calculating percentage changes is whenever I have only 2 financial years information. Whenever I have more than 2 years, I have 3 years or 4 or more, it is advisable to use the second technique, which is the calculation of trend percentages. Okay? So let's continue. That's an illustration of what the percentage changes, in this case only the changes in percentages shown over there, between 2 financial years. What we have here is a hypothetical company, and we have some information. Actually, it's a mixed information from several financial statements. We have the turnover, the operating result. Turnover is the sales revenue, by the way. Net result, they come from the income statement. Then operating cash flow and cash flow net result, they come from the cash flow statement. Changes in treasury position, balance sheet total equity, they come from the statement of financial position. And also ratio over here, which is the long-term debt to equity, a ratio that we introduced last time together. Now, what we do is that we compare information from 2001 to 2002, as we can see here. And this information is presented in percentages. For example, the turnover is increased by 9.3%, whereas the operating result has declined by 1,208.7%. But be careful, as we mentioned, this is a very strange or abnormal situation when we are jumping from a profit, a positive operating result, to a net loss or a negative operating result. So we are comparing basically a positive amount to a negative amount, and that therefore this percentage change over here is not very meaningful. Be careful when you interpret that and how you understand that, because if you say that the profit, the operating result has decreased by 1,000%, you may go crazy. Sometimes this is not really logical, but when you present the data, okay, it was like from 15 million, we jumped, we skipped, we went down to 163 million. Okay, that's again is more than 1,000 in percentage, decline in percentage, but still it's more comprehensible. What I'm trying to say here is that sometimes when you perform the trend analysis technique, the comparison between figures, which one of them is positive and one of them being negative, makes it difficult to interpret the value. So be aware of those occasions. Again, the net result over here, if you can see, from a loss, 14 million, it is an even bigger loss in the second year, 325. But if you mathematically calculate the percentage over here, it will show up as an increase. So if you would say to somebody else that you see the net profit is increased and is increased by 2,226%, that would seem like, wow, what a performance of a company. But if you look at the figures over here, we are not even operating at a profit, we are operating at a loss, and only because of mathematical way of doing the calculations, it comes up like a increase over here or an improvement. Okay, so be aware of using the trend analysis. This example over here is just to make you think that, okay, you will perform trend analysis, but whenever you find some abnormal figures, these changes in percentages in thousands, try to look beyond that. Try to see the actual figures. What is the actual amount of that item in first year and second year, in order to have a better understanding of the situation. Okay, so I guess that's clear for everybody. So what is strange, I have put that in red, because that means really something is not okay. Where this table changes from the table in the previous slides is that I have included two other columns over here, and that is how we are required to perform the trend analysis for this course. As I mentioned, the trend analysis involving 2 financial years will require from us to calculate the difference in accounting or monetary value, and also the difference in percentage. As I mentioned, later we'll have the illustrated example of PSA company, Peugeot company, let's say, and we will explain how to calculate the trend percentages. Okay, something that is already linked to the horizontal analysis, and maybe we can discuss that before we jump to the example. We have here the information about Lufthansa company. That is a comparable information because we start from 2014 until 2018. And you can see that there are like 5 financial years included in there. And what we have done to perform the horizontal analysis for the case of Lufthansa is that we have used trend percentages. How do we know that? Because we have, as a first step, we have identified the base year, and the base year is usually the first year in the time frame in the financial analysis, and then every item from the base year, we know them, or we express them as a 100%. So all the data in this table over here are in percentages. Okay, so what basically do is that we compare each of the other years, 2015, 16, and so on. We compare to the values of the base year and express them in percentage. For example, the traffic revenue, which is the biggest source of revenue for aircraft companies, the traffic revenue has increased from 2014 to 2015 by 4%. How we understand that? Because the percentage from 100 has become over here 104. That means that we have an increase in the traffic revenue by 4%. What about 2016? You see that the percentage is 101. That means that we have, compared to the base year, we have an increase of only 1%, but compared to the previous year, 2015, we have a decline by 3%. Do you get that? Do you get the situation now? So the technique of trend percentages helps us to have an understanding of a bigger time span, a larger time span rather than 2 years. I can compare the activity not only to the previous year, for example 2016 compared to 2015, but also to a base year, which is like the normal basis of operation and activities for the company. So this is what the horizontal analysis can do when we use the trend percentages. Again, you can see that there are values up and down over here. So applying the trend percentages technique helps us to reveal whenever an item has been decreased or not. For example, you can see there are a lot of variations and fluctuation in the change in inventories and work performed. The change in inventories is decreased in 2015 because it's only 95%, and then it is even furthermore decreased in 2016. It is 44%. Then it has more than doubled its value to 2017, becoming 106%. That is even more than the base year that we start in a base level 100%. Again, the horizontal analysis, whenever you have more than 2 years, is very helpful. But I guess in the case of your group works, you will have only 2 accounting years. So you will have to use the simple horizontal technique, that is, calculate the difference in monetary value and calculate the difference in percentage between both years. Okay? So we have the same thing about EasyJet over here, another company operating in the same sector. And if we have the same, let's say almost the same items, you can see that we cannot have the same items because companies may use different words for the same thing. For example, Lufthansa has traffic revenue, whereas EasyJet considers that passenger revenue. Okay, Lufthansa has other revenue, for example, offering other services on board, whereas EasyJet considers that ancillary revenue, so secondary revenue. Even though there are different names for the same thing, you can see that there are almost the same kind of revenue and costs in both companies. Applying the horizontal analysis for EasyJet for the same time period, 2014-2018, helps us to analyze not only EasyJet, but also to compare the 2 competitors together. What is special about Lufthansa? What is special about EasyJet? Now, this is just an illustration to make you understand the potential of using the horizontal analysis technique. The more years you have at your disposal to use, the best it is. You perform a horizontal analysis, and if you want, you can select a competitor in the market as another benchmark. Remember that this was another benchmark in financial analysis. You can select a competitor in the market and perform the same kind of analysis for the competitor and then compare the 2 together. Do you get the potential of the use of horizontal analysis? It is very useful actually. Before we jump to the common size analysis, I would like to explain how we can, let me share the Excel file, how to perform the horizontal analysis for a real case company. Now you can see my screen, I guess, the Excel file. Remember that we have chosen for today, we have chosen the application for the Peugeot company. I'm not using anymore Carrefour company, just to change a little bit the background and activities of a company. What we find in the statements of annual report, there are several items over here. For reference, I have put here also the extract as copy-paste from the annual report of the consolidated statement of income, just to make you understand how we get the figures, okay? So we start from net sales, and the net sales are the amount of revenue over here. Of course, I had a look at the note 6.1 to make sure that this revenue was not including something that should not be actually there. So anytime you have a reference over here at the notes column, make sure to check that note and to see what is really included in there. Then I have written the amount of the cost of sales, you see, is cost of goods and services sold. The gross profit is not reported in the face of the statement of consolidated statement of income. The gross profit is not included, but I have calculated that as a difference between net sales and cost of sales. As we have already mentioned, the gross profit is a very important item in analysis. It's not in financial reporting. That is why you don't usually find that in the statement of income. But regarding financial analysis, the gross profit is a very good measure to compare companies together, especially companies that operate in the same sector. Why is that so? Because gross profit is unaffected from other operating, financial, and tax expenditure. Gross profit shows only the difference between sales and cost of sales. You may have other big or low costs in operating, selling, general, administrative, and so on, but that does not affect gross profit. So it allows you to compare companies that may have chosen different amounts of operating activity expenditure. They may have chosen to take many debts, they may have chosen to pay less taxes and so on, but gross profit is not affected by these other decisions. Gross profit is affected only by how much do you generate from selling and how much did this stuff inventory cost at the first place. So we include always the gross profit in our financial analysis, even though we do not find that item in the statement of income. Then we subtract the operating expenditure, it's over here, it's easy in this case, and we calculate the operating income or EBIT as the difference between both. Actually, in this case, operating income or EBIT is stated in the face of the income statement. That makes things easier for us. One clarification about the finance cost. I have included an extensive note over here for all of you that have asked during this time. You have wrote to me by email, many of you asking what to include in the finance costs. Now that depends. The best option is to take into consideration only the financial expenses. Okay? In this case, I have the financial expenses readily available in the financial statement of Peugeot company. As you can see, financial expenses are the amount disclosed here. But sometimes the way the information is presented in your financial statements is such as you cannot understand how financial expenses are calculated. Maybe you can have the item net financial expenses or net financial cost. In this case, you have to go to the notes in the financial statements and find out the composition of this item. So what I'm saying over here basically is that it is best to always refer to the interest expenses only. That is the best option. If not possible to have this piece of information, you should consider financial expenses. Now, financial expenses are the sum of interest expenses and other financial expenditure like bank commissions or financial rent expenditure and so on. In case you do not have interest expenses, you should take financial expenses. But if it is not possible to have or to get the information from the if it is not possible to get the information neither from the financial expenses, we have to consider and refer to the net financial costs over here. Okay, so this is like something that we have to keep in mind whenever we have to analyze the financial expenses. There were several of you asking questions about this. I responded to you, but to make a clarification for all of you that probably will continue later with your group work project. Next, we calculate the earning before taxes. Sometimes it is disclosed in the face of the financial statements, like in our example over here, we have the the income loss before tax. That is the earning before taxes. Then the income tax expenses, again, always the sum of current and deferred taxes are to be included there. And then we continue with the net income. In case you have net income only related to the continuing operations and making a distinction between continuing and discontinuing operations, you should include this item over here. Usually in our examples it was not relatable. Why? Because if you see, the whole income statement over here relates to continuing operations. So the whole items, all of this money over here relates to continuing operations, no discontinued operation for Peugeot company for 2020. Then we have basic earnings per share, diluted as well. All of them are extracted from the financial statement. So when we have this information, let's make the necessary calculations. I'm just copying and pasting the information into another sheet over here. So we have the same data that we mentioned, and that is related to 2020 and 2019, and how we can do the calculations. First of all, we will apply the calculation of the horizontal analysis. The horizontal analysis or the trend analysis involves calculating the change of this item from the first year to the second year, and then involves calculating the percentage of that change. For example, if we refer to the net sales, we can see that the difference from one year to the other is, okay, sorry about that, my bad. We deduct the amount in the first year, sorry, but I just wrote it by mistake. We deduct the amount of the first year from the amount of the second year. And here we can see that actually we are having a negative change. That means this is a negative amount, it is a decline, it is a decrease. You can see that the net sales have decreased from 2019 to 2020, and the decrease is 13 million. So the data is in millions of euro over here. Okay, so keep this in mind. It's not few money. So if we have a decline in net sales by 13 million, relatively, what does that mean for a company of this size as the Peugeot company is? For a smaller company, 13 million can mean a lot, but for the company that we are referring to, the percentage of this change is the comparison between the change in monetary value itself to the base year or to the first year. So we are talking about over here a decline in 18%, which is not a small amount, but for a smaller company it would mean a higher decline, even higher decrease. So we perform the horizontal analysis by comparing year to year, basically by deducting the figure of the first year from the figure of the second year by formula that would be over here. Let me add a simple formula to guide you in your future calculations. So value in year 2 less value in year 1. That would be like a very simple formula to apply in this case. Okay, whereas the percentage of change over here is equal to the change itself that I already calculated in that column to the value that that item had in year 1. So this is the formula that we apply to calculate the change and the percentage of change. Is that clear, or do you need me to repeat that again? I hope that is easy to understand. So the horizontal analysis, the trend analysis technique, we are not talking here about trend percentages. Trend percentages would be applied in case I have more than 2 years. 3, 4, 5, like the case of Lufthansa and EasyJet. We select the base year, usually the first year in the time horizon, and then we express every item in the base year as 100% and compare each of the future years to the base year. That is another technique. We are going to learn about that later. But right now, illustrating the information for the Peugeot company and having only 2 years, I'm applying the simple technique by calculating the change in monetary value, simply the difference between the value of item in year 2 minus the value of that item in year one. And then calculating the percentage of that change. That means how much does this change actually mean for a company of this size? Okay, so we see that net sales have decreased 13 million, and that is not few even for this big company. It is almost 20% decline. Okay, so we can do the same for every having Excel. It's easy for me. I'm just copying the formula, and that is why Excel is really very good whenever we apply in financial analysis. What did I do is that I just copied the formulas to calculate the differences in monetary value. What do you notice? You notice that actually every item has been decreased. So we have a decline in the activity of the company. More to interpret about the decline in the activity later after we have a short break. Okay? So 5 minutes break and then we continue. Okay, maybe we can start. Can you all hear me? Okay, I'm having some problems with the internet connection today, and I hope we are going to finish successfully our lecture. So in case we have some interruption, just be patient, please, until I reconnect and restart the internet connection. So again, what we are discussing is the horizontal analysis or the trend analysis. In case we only have 2 accounting years, it's very simple. We just calculate the change in value and the change in percentage. The change in monetary value is simply the difference between value in year 2 minus value in year 1, which is year 2 and year 1. It depends on the time horizon that you are referring to. Whereas the percentage of change actually compares the change itself toward the value of that item in the first year, just to have an idea about the relativity importance of that item. For example, what we can see is that actually every item in the income statement has declined for Peugeot company, as we were expecting to happen actually in 2020. I guess you are going to find the same thing for your own companies in the group work. Making the calculations is one thing, but you are also required to interpret and comment on the information. So what can we say? What has happened? The net sales have declined, but also the cost of sales have reduced, as you can see. The fact is that the cost of sales have reduced by a lower amount than the net sales, making the gross profit reduction really very considerable. You can see that the gross profit has been reduced by almost 30%, and that is huge to consider. Again, why has that happened? Because you have declined the sales, but the cost of sales has been reduced by a lower amount. Mathematically, this means that the profit margin that you are generating is going to become lower. Okay? So in this case, you have to be really very careful in understanding the reasons why the gross profit has been declining. Again, you see the same trend. You have a decrease in the operating expenses by 22%, which is again lower than the decrease in the previous item, gross profit, and that causes the operating income, EBIT, to decline by an even higher percentage, that is 35%. Okay, as you can see over here, we see the same trend. All the expenditure, like cost of sales, I'm putting that just in a red character color, all the costs have been declined, but actually all of them have been declining by a lower percentage than the profit right before them. And that just makes the profit margin really being reduced one by one even further. We have gross profit reduced by 20%, operating income, EBIT by 34%, and look here, earning before taxes 36%, and net income even more 43%. Again, every item of expenditure that I'm putting in red color, every item of expenditure is being declined, has been decreased, sorry, but actually has been decreased at a lower rate than the previous profit item. And that causes the net income, for example, to be decreased by a certain amount which could not actually be avoidable, and we have to focus on that. Of course, the horizontal analysis is just the first step of financial analysis. We will continue with the common size statement, the ratio analysis, and that will reveal the reason of having such a bad performance. Okay, but what we notice here is the decline in sales, a decline in expenses, but the decline in expenses is lower than the decline in sales, and that brings every item of profit, from gross profit to operating to before taxes, after taxes, to be even lower than before. Okay, I really hope that that is quite clear for the moment. We use the Excel illustration to show how the horizontal analysis actually work. And right now we are jumping again to the PowerPoint presentation with another technique of analysis, which is common size analysis. It is sometimes known as the vertical analysis or the structural analysis. What we basically do in a common size statement of financial position, we express each item as a percentage of total assets, whereas in the common size income statement, we present each item as a percentage of sales. That means that in these both statements, which are really very important in financial analysis, you have seen that calculating the ratios, we mainly base our calculations in these two financial statements. Financial statement of financial position and income statement. Now, what we do to present this statement in a common size format is that in the balance sheet, we take each item and compare it to the total asset and expressing that in a percentage. That helps us to represent the balance sheet in a common size. That means if I have percentages there, that is something that becomes comparable with other years or with other companies. In the income statement, we do the same thing, but here every item of revenue and every item of expenditure is compared against total revenue or as a percentage of sales. And we can understand the importance or the impact of each revenue and each expenditure item. Sometimes, as I said, is referred to as vertical analysis to make like a connection with the horizontal analysis that is related to the way we perform calculations. In the horizontal analysis, you calculate from one year to the other. In the vertical analysis, you perform the calculations taking one item and comparing to the bottom total of the assets. Okay, so this is usually referring to the way we perform calculations. Another term that I personally prefer to use is structure analysis, actually, because calculating the percentages reveals the structure of financial statements. If I have a balance sheet in percentages, I can see what the structure of investments is. What is the percentage of investing in inventories? What is the percentage of investing in fixed assets and so on? So this is known as structure analysis, another name for the common size analysis. Again, I emphasize what I mentioned before. If you convert a performance statement or a financial statement into its common size, so you take values and monetary items and convert them to percentages, you can compare companies to each other. Of course, considering the red flags that we mentioned in the beginning of this lecture today. And therefore, we have this name common size. They become comparable with each other. Which are some of the uses of the common size analysis? We can compare company performance and financial position with other companies for the same year, preferably in the same industry, as we are going to see later. The differences in company characteristics should always be accounted for in interpretation. A bit later, we'll have an example with four, I guess, different airlines, and we will see how one specific item is different in companies, and we have to pay attention to these differences always. Another use is that it standardizes financial statements by introducing a common denominator. What is this common denominator? The total assets of each company. If we compare all their investments and financing with the total assets of each company, and each company is considered 100% regarding their total assets, we can standardize the information between them somehow. As we said, sometimes called vertical analysis as to connect with the horizontal analysis. Now, what we have here is the common size analysis of EIG and EasyJet. As you can see, the common size analysis of the income statement and some items from the financial statement of financial position, you see that total revenue in both companies are considered as 100%. And we compare all the item of expenditure to the total revenue to express them as a percentages and to understand how much this expenditure required to be covered or required to be repaid. For example, the passenger revenue contributes 88% for IAG, whereas for EasyJet, the passenger revenue contributes only 79%. You can see the operating costs. They are 86% in IG, whereas they are 89% in the EasyJet company. So this means that if I take and compare the common size statements between two different companies, even though they are different sizes, we can have an idea about how good or not good their activity is going on. Okay, so this is the idea of using the common size analysis to make possible the comparison. Of course, be careful because there might be items over there that are hidden in the accounting principles, accounting regulations, and I should pay attention to how this differs and affects our interpretation. To advance our studies over here, we have four companies, IG, Emirates, Lufthansa, and EasyJet, and what we have is the statement of financial position. Okay? In the statement of financial position, we are representing not all of the statement, but the most important items. For example, total non-current assets that are represented by intangible assets, tangible assets, financial instruments, and also the current assets by their items, inventory, trade receivables, financial instruments, and so on. In the next slide, I guess we have, the liability side. But if you can see over here, expressing the items as percentage to total assets, you see here total assets for for the four companies are 100%. These are all percentages, okay? Comparing them becomes easier. For example, I can see, we can see that the highest investments in tangible assets belongs to Emirates Corporation. You see they have 71% of their total assets in aircrafts. Okay, that is tangible assets, property, plant, and equipment. Basically, for these companies, it is the aircraft that they operate, the fleet that they have and operate. Whereas the lowest is IG. They have only 44% intangible assets because some big investment for them is total current assets. You see, it's 36%, the total current assets, representing by other current assets 5% that we have to check in the notes. What do they include? So again, representing the statement of financial position in percentages through the common size technique or the vertical analysis helps us to compare companies together. Of course, this needs further investigations. This needs and requires from me to open the financial statements of this company and check about the disclosures and what they actually include in each item. But something that we notice is that the biggest investments in fleet or aircrafts belongs to Emirates company. Okay. What we can notice from the liability side, and this also relates to a question that I had left in the slides. We will find the answer for the question over here, not to take time right now, but I've provided the answer already. In case you have any idea, you are free to discuss. Right now we have the liability side. We have done the same thing here. Every item is expressed in percentage related to total equity and liabilities. Again, total equity and liabilities are 100% for the four companies. And we can see the structure of financing for all of them. For example, something that I would comment on, financial liabilities. I'm just taking one item. Financial liabilities, they are the lowest for the EasyJet company, whereas the highest for Emirates company. Something that I left as a point for discussion was the discussion about the trade payables and the unearned flight tickets. Now you can see that the Emirates over here, they have different values for trade payables and unearned flight tickets, very different from the rest of the companies in their sector, in their industry. Okay, so all of them have trade payables around 14%, 15%, and unearned flight tickets. What do they represent in order to better understand together? Unearned flight tickets, what do they represent? Anybody has any idea what unearned flight tickets represent? You remember the concept of unearned revenue. You remember that, I guess?
Can I say
So it's
something?
the same as unearned revenue. Unearned flight tickets include or represent the liability of the company towards its customers regarding the tickets that are sold but has not been recognized yet. So these are advances from customers for tickets for flights that will happen in the future. We have sold the tickets as a company, we have collected the money, but we are not offering the service yet. It will be offered in the next year. And so we recognize this liability in the item unearned revenue. In this sector, it will be known by the name unearned flight tickets. So you can see that this is usually usually low for Emirates and high for the other companies. So how can we understand the difference between them? For both these items, trade payables and unearned flight tickets, we can have the Emirates company that is reporting values that do not comply with those of the competitors in the same industry. So we have to make some, let's say, some investigation. Why? That means that we have to go and see carefully the disclosures in the financial statements of the four companies, something that obviously you do not have time to do, and therefore I have provided the answers over here. So if we check the financial statements of the companies, of each of them, and we check what they include as part of current liabilities, actually as part of trade payables and deferred revenue on ticket sales, you can see that sometimes it's a different name, but it's the same thing. For example, IG, they have deferred revenue on ticket sales, whereas Lufthansa calls them liabilities from unused flight documents. But actually, it is the same thing. It refers to tickets that are sold, but the flight will happen in the next year. You can see that almost the figures are the same between these companies. We continue with the other two companies, EasyJet and Emirates. EasyJet has also trade payables and unearned revenue. So what they call this is unearned revenue, whereas we see Emirates over here, a very high amount in trade payables, as you can see, 26,000 millions, whereas the deferred revenue, which is the unearned revenue as well, it is unusually low. That means that we have to check again the disclosures in notes 29 regarding trade payables and 26 regarding deferred revenue. Okay, so we continue. Regarding the three first companies, IAG, Lufthansa, and EasyJet, they report similar information as we saw. We have the amounts in trade payables and the amounts in unearned revenue, unearned flight tickets, and so on. They represent the money they collected for flights which have not been occurred yet. Instead, yes, we are going to mention in a bit. Instead, in deferred revenues, Emirates disclose this information. Now, if you can see over here, in deferred revenue, is in Emirates is not related to the unearned revenue. In Emirates, the deferred revenue is related to the frequent flyer program and represent the fair value of these outstanding credits. So basically, the deferred revenue in Emirates is not the unearned flight tickets, but it is just the frequent flyer program. Okay? So this means that probably this unearned revenue are included in the other item, trade and other payables. So we jump at note 29 and we check the trade and other payables. And what we see there? We see the items trade payables, okay, passengers and cargo sales in advance. Be careful with that. This 11,000 millions over here. So passenger and cargo sales in advance. This is the unearned revenue. This is the tickets we sell in advance and then we offer the services later, at some months later. So basically what has happened is that Emirates is including the unearned revenues under the item trade and other payables. It is not violating any accounting standards or financial reporting standards. It's just a matter of representation and layout and format. If we compare the four companies, we may find at first sight like Emirates has something not okay, something is not going as it should be, something is wrong with this company, but not really. If you go and investigate the financial statements of the company, we find that actually Emirates have unearned revenue. They call them passenger and cargo sales in advance, but they include that in another item, trade and other payables. Whereas what they actually consider deferred revenue is related to the frequent flyer program. Okay, we have a question from one of your friends. No, Claudio, actually this is not, that would be that would be a very good solution, but this is a very good airline company that we are talking about. Actually, they perform and recognize the revenue according IFRS 15. So now for revenue recognition, I'm just writing in the chat something. So all of them, they apply IFRS 15 for revenue recognition. That means that whenever they sell the ticket, they have to recognize an unearned revenue in liability side. The problem here with Emirates is a matter only for representation and layout and format of the liability side. Okay, thank you, Claudia. This is just for me to make a summarization on the example. This is a simple situation when you can get the wrong idea. You can get the idea like one company has something not going on really well with the items in the financial statements. But if you check carefully the notes, this is why constantly I emphasize the importance of the notes of financial statements. They explain things. You may investigate, you may find something that is suspicious at the beginning, but when you go and look very carefully at the information, you see that actually all the data is there and is pretty simple to understand what's going on. So I hope that this was understandable for all of you. So again, the common size analysis is useful, but may have some constraints. Okay? Emanuele is a very good question. As a matter of fact, Emanuele, last year I asked the groups to be combined in pairs. That means that I identified the companies according to the sector they operate, and I made them present one after the other so they could compare both companies together. So last year I did that. But this year, we could not do that because we are doing the presentations at class and some of you are not even there, so it would be difficult to keep your attention for all the sectors and industries. So, Emanuela, the simple answer, short answer is no, you are not required to do so. Even though last year we performed a comparative analysis during the presentation, and it was really actually interesting. You are not required to do that unless you want to go one step further and you want to do that step, that extra step, but I'm not requiring you to do that. I hope that is understandable, that is clear for all of you. Okay, so now we can go on with the Excel file again and see how in our file over here, I hope that you can see my screen. I have prepared the columns that relate, sorry, the columns that relate to the common size analysis. This is the vertical, so-called vertical analysis, where we present in percentage the values in the different statements. What is a common formula that we can use over here? Value of the item related or compared to the total of the financial statement. So always I should express a percentage that item to the total financial statement. Now it depends. In income statements, the total is the net sales, whereas in the balance sheet, the total is the total assets. So probably I will start with net sales for 2020 with the net sales from 2020. So you can see that it is 100%. Then in 2020, the cost of sales is 81%. That means that out of 100 euro sales, you need to spend 81 euro to cover only for the cost of sales. Remember, cost of sales includes direct material, direct labor, conversion costs. We are at Peugeot company, they are manufacturing vehicles. So their cost of sales include direct material, direct labor, conversion costs, and 81% cost of sales in the structural analysis means that out of 100 euro sales, I will immediately spend 81 euro, 81.64 euro to cover only for the direct material, direct labor, conversion costs, such as depreciation and so on. That means that the gross profit is either the difference between both of them, or I continue with the formula, the ratio between gross profit and net sales. So everything is compared to the net sales. We continue with operating expenditure, selling, general, administrative. Operating expenditure represents 8%. That means that out of 100 euro sales, I will spend 8 euro and 26 cents to cover for this selling expenditure, general administration expenditure. That means that the operating EBIT, the operating profit for this company for 2020 is 5% only. Out of 100 euro, after covering for the cost of sales and operating expenditure, I'm left with only 5 euro profit, operating profit, for each 100 euro sales. But I still have other costs to consider. Like, for example, we have the finance cost. In this case, these are interest expenditure. Then this means that the earning before taxes in percentage is 4.51%, right? So if we continue again in the income tax expenditure, that would be in percentage like just 1%. And that means that the net income in 2020 is in percentage 3.33%. That means that out of 100 euro in sales in 2020, only 3 euro and 33 cents are left as net income. Okay, so this is why we make the vertical analysis, or we perform the structural analysis. We convert the income statement into a common size statement to understand what is the impact and the importance of several expenditures. You will always find that the most important items that need to be analyzed are cost of sales and operating expenditures. They are the most important items, and I should see their change from one year to the other. We performed the vertical analysis for year 2019 as well. So you can see the trend and the value, for example, for cost of sales. Do you see over here? The impact, the relative importance of this item in the structure has been increased actually over years. That means that in 2019, out of 100 euro, I would spend only 79 euro to cover for cost of sales. But in 2020, I have to spend more to cover for the cost of sales. That explains the negative percentages also in the horizontal analysis. That means that you have to interpret the two techniques, the vertical and horizontal analysis, relating to each other, trying to understand what has really happened. Actually, we have a decrease in cost of sales and in monetary value, but their importance, be careful about this, we see that we have a decrease in the value of the cost of sales. At first sight, you would see, oh, that's good. Maybe you'd think that. We have a decline of cost of sales from 59 million to 49 million. That's okay. No, that's not okay. Because this is happening in the same year when we also have a decrease in net sales. So normally the cost of sales would be down, would be less. But actually we see that even though it has declined, it's been decreased, the relative importance of the cost of sales compared to sales is increasing, and that is not good. That is the explanation why, after all, the gross profit is declining by this rate. Okay, let's calculate the gross profit, by the way, as the ratio of gross profit to net sales. Okay, we have here 20% in 2019, and we are at a lower margin at 2020 at 18% over here. So you can see that this is a decline that is caused by the increase in the importance and structure of the cost of sales. We continue with the operating expenditure. You can see that there are a lot of calculations involved, but still that is something supplementary to the basic ratio analysis that we are going to perform for our companies. You see the same trend in the operating expenditure, right? They have been decreased from one year to the other. At first sight, if you just see the figures and numbers here, you'd say, okay, that's good. From 6,000 million to 5,000 million, that's fine. No, that is not fine, because we have also a decrease in the activity in the net sales. And actually, we see that the relative importance, okay, of the operating expenditure is less in 2020. Okay. Operating income, or EBIT, again, we do the same calculations regarding the net sales, and all these percentages are important to interpret, but still you are not going to cover and discuss about each specific item. My suggestion is to stop only for those items which are really important to be discussed. For example, something that we should inevitably discuss why is happened is the decrease in the net income percentage. In the 2019, we had 4.8 euro profit out of 100 euro sales, whereas in 2020 we have only 3.3 euro profit, and that's not a good thing. That we need to clarify, we need to discuss and find out the causes and the responsible persons and reasons why this has happened. Of course, the vertical analysis can be performed also, as well as the horizontal analysis can be performed also to the amounts of the statement of financial position. As we saw, having further information about our companies required us to show the items of non-current assets, current assets, debtors, inventory, total assets. You can see the total assets are 100% in both years in the vertical analysis. The same with total equity and liabilities. They are also 100% in the vertical analysis. Whereas when we calculate the change and percentage of change, and this maybe requires some minutes of interpretation, you can see that the total assets actually have increased in 2020. Even though we have decline in the activity, we have less sales, the total assets are increasing from 69,000 millions to 73,000 millions. That is an increase by almost 5%. How can we analyze the amount of increase in total assets? we usually compare this to a competitor. In case we do not have the data or information from a competitor, we can interpret this change in total assets to the overall economic GDP increase or decrease in a certain year. What has happened with the overall economy in Europe or in the world? Actually, we know that 2020 was not a good year, so having a company that is increasing the size of the activities of total assets by 5%, that is something that should be considered favorable for this company. So something that you can do when you calculate these amounts and try to analyze them is to see if the total assets of other peers, other competitors are moving in the same direction, or the average values in the industry. In case you don't have these values, just try to compare the percentage of change in total assets to the overall economy. Having in mind that 2020 actually brought decrease of activity in many sectors, in many industries, this 5% is not bad. Next, I will focus where was the increase in value. If you can see, the item in the financial statement that actually increased a lot was, the current assets over here. They are increasing by 12%, whereas the non-current assets, that is property, plant, and equipment, actually they have been decreased from one year to the other. So it is the current assets that explain the increase in the total assets. Whereas from the financing side over here, liabilities and equity, you can see, of course, the same change in total equity and liabilities, but we can see that the change has been in non-current liabilities, okay? And it is almost the same as the change in the current assets. You remember what we mentioned as a financial rule to have a matching between maturities of financing and investing? Something that we mentioned in another chapter was that usually companies, when they provide financing, they should be careful to use this financing for investments in the same time frame. In this case, what we can see from Peugeot company is that they have incurred a lot of non-current liabilities, that is long-term debts, debentures or loans, and they are using this money to invest in short-term assets or current assets. So basically, what we can understand from at least these figures is that the company is not really respecting the rule of matching financing sources with investments opportunities, okay? So this made me, at least, to look a little bit more about why the current assets have been increased so much, as you can see over here, and to understand why. So what actually I did was that I referred to the cash and cash equivalents only. You see this matrix over here? It was very interesting for Peugeot company because the cash and cash equivalents only for 1 year increased by 28%. That means that regarding the structure of the investments, 31%, can you hear me? Can you all hear me? I think I had my camera freeze. Okay. Thank you. I'm switching off my video so the internet connection will not be impacted. As I said you, there are some problems today here in my office. So what I was saying to you is that I became interested. By calculating what I said, I thought, okay, what is wrong in the Peugeot company? Why is it increasing the non-current liabilities and investing in current assets, and where exactly in the current assets? When I went and checked the financial statement, the financial position, I saw that the item that was increased in a very unusual way was the cash equivalents from 25% of total assets, which is a very high amount. To have so much cash for a manufacturing company seems like a bit odd, because usually cash is used in operating activities. It's not left as cash reserves. And we also saw that it was increased even further, representing in 2020 31% of total investing. Now, this means that 1/3 of the total resources, the total wealth of Peugeot company is cash. This is something to keep in mind. We are here having a company that manufactures and merchandising vehicles, and yet 1/3 of their wealth is cash and cash equivalents. And here it is divided into two parts: cash of manufacturing and sale companies, and also Peugeot has some finance companies that finance the sale through leasing contracts to customers, but that is very low amount. So what represents the biggest amount of cash is that of manufacturing and sale companies that are part of the Peugeot group. Now, some clarification what they include in cash and cash equivalent. I went and checked the note B in their financial statements, and they disclosed that the cash primarily represents cash, okay, excludes bank overdrafts, as we previously explained. If it was bank overdraft, it would be on the liabilities side and not a current assets. And cash equivalents consists of investments that are readily convertible, are held according to IS 7 cash flow statement. Remember that whenever we have some investments less than 3 months, they are considered cash equivalents. So this is money in the bank or short-term trading investments, okay? We took many minutes to explain the situation of Peugeot company, but you are expected to do the same for your own companies. You are expected to perform the vertical and horizontal analysis for these items that you are going to again use for the calculation of ratios. I'm not requiring you to perform vertical and horizontal analysis for the full statements, okay? Only for the items that we recognized as important to include in the calculations of ratios later. And you have to comment on everything unusual that is going on. I think that analyzing 2019 and 2020, we will have a lot of interesting results, and we can see how companies face that difficult year that it was last year. Okay? Any questions so far? What you probably maybe did not understand, or something that you want to know regarding your requirements about the group or project. So basically you have to do the same thing as here. And of course, this Excel file will be uploaded in Moodle when we are done. We'll lecture today, so you'll have all the information. Okay? Any questions so far? We are done with illustrating at least the two new techniques, the trend analysis and the vertical analysis. I think that as there are no questions, everything is clear. I'm continuing with the presentation. We covered so far two types of analysis, which is trend and common size analysis. The third technique is the segment analysis, but we are not going to apply that for our group work. I'm not going to require you to analyze the segment reporting, just to mention and disclose some information, as we said. So again, segment reporting was covered in a previous lecture. It was IFRS 8 that regulates the segment reporting. It means breaking down and representing the activity of the business according to segments that they recognize from an internal point of view. It is interesting that segment reporting offers better understanding of the entity's operating model. It helps to assess the entity's risk and returns and exposures and threats towards different industries or different clients, and helps us as decision makers to make more informed judgments about the enterprise as a whole. It is suitable, as I mentioned here, for more in-depth inside analysis. That means we are performing outside analysis. We are performing external analysis. That means that we are not required to do segmental analysis, because that requires, beyond the reported information about segments, That requires also some confidential data or some insider information that we do not have. That is that we are going to discuss about segmental analysis, but probably you are going to use and apply that later when you work in different jobs or different companies. Ratio analysis is the one thing that it's already covered, so nothing new in that. I'm just going to remind you of the ratios that we mentioned in the last chapter. Through the ratio analysis, we do not focus on specific financial statements. I do not focus on income statement, for example, or the statement of financial position, and I do not compare the items with the total of the financial statements, or I do not compare the item with the value it had the previous year. No, in the ratio analysis, we calculate mathematical ratios that usually have the form a numerator towards a denominator, and we want to calculate comprehensive, consistent, and meaningful ratios. That is to understand how the company is performing. Sorry about that. So we want to know about the performance of the company, or how profitable and efficient it is, what is the profit that it is generating, whether or not it is utilizing the assets in an efficient way or not. Second, we saw the financial position, and the financial position in the short term was recognized by the term liquidity. The financial position in the long term was recognized by the term solvency, or gearing or leverage ratios that we mentioned as synonyms. And another point of view, another perspective of ratio analysis assumed the investors. That is that a good investment, buying shares or buying bonds and debentures of this company? Does that represent a good investment? Usually, in the third category over here, we calculate ratios that combine together financial data from financial statements to information coming from the market, such as the share price in the market. So something to link the ratio analysis and the IS accounts. There is no standard layout for the accounts, only a minimum list of items. This explains the variability of the items that you are all reading into your own companies. Each of you is studying a different company, and you can see that there are not the same items. That is because the IFRS and IS1 that regulates the layout of the financial statements, IS1 does not does not make it require the standard layout for the accounts. They mentioned only the minimum list of items that should be present in the face of financial statements. And the companies actually may choose to include even more information than a minimum required. That explains the variety of all financial statements that you are dealing with. Now, also take into account the results of the company and other elements, items of comprehensive income, plus items of the statements of changes in equity. Something else to consider is that sometimes the IFRS allow very different valuation rules, different valuation models. Just to mention one, for example, regarding the fixed assets, we may value them either through historical cost, or amortized cost is the same thing, or through fair value. And that causes a big difference in the values that are reported in the income statement and statement of financial position, and also it has a huge impact on the ratios. At a later chapter, we are going back to this topic and discuss it further, but for the moment, just please know that because IFRS allow alternative valuation rules, the companies may choose alternative models, thus not breaking the standards, not violating the IFRS standards, but still making them less comparable to each other. A reminder of the formulas that we discussed in the last lecture. We mentioned three ROI, three return on investments measures. That was return on equity, basically net profit available to shareholders compared to equity, return on assets, basically EBIT compared to total assets, and return on capital employed, which had the focus on the long-term capital only, basically profit before taxes plus long-term interest. In case we cannot distinguish which part of the interest is long-term, we include all the interest over there, and we compare that to the equity plus long-term debt. As we saw, each of the ROI figures could be disaggregated into two components. ROA is disaggregated in a profit margin, that is profit to sales, and the second component is the assets turnover, total sales to total assets. So we could see how the company is generating its return on assets through a higher profit margin and a lower turnover, or vice versa. We also mentioned, and keep this in mind, a certain company cannot have both. Cannot have the profit margin and the asset turnover high. One of them should be moderate. Okay, we have a question over here, which the answer is provided. Which profit is the most meaningful to be combined with sales in the ROA ratio? We discussed why we include the operating result. That is because we are not considering here the financing activities or extraordinary or exceptional results. That is, I have to take into consideration an amount of profit that is not affected by the financing structure. And that is why we choose the operating result. Okay, we have a simple explanation, which is also in the textbook, a simple representation of ratio analysis for Nestle and Unilever. These are two companies that operate in the same sector, and you can see that calculated over there are the return on assets and return on equity. Something that you notice is that, something that you notice, and I want to ask you about that after the break, is why question. Why the ROAS of two companies differ so much, while the ROA are almost the same. So again, we are going to have a break. During this break, I'm going to leave this on screen. And the question that we are going to discuss is the ROAS of both companies are very different, whereas the ROA are closer together. So how can we explain that? Okay. So we are ready to start. Okay, in general, I am very pleased with the comments in the chat. Yes. Okay, that is the answer. Yes. If we can continue to the answer, summarized answer that we can give to that. The difference between ROA and ROE is only the leverage, the financial debt or loans that the companies are using. And as we can see from financial statements that we have for both companies, in case we analyze their information, they have a somewhat different amount of debts. So ROA is affected by the financial structure. Why? Because it is calculated by dividing the net profit to the shareholders' equity. So not taking into consideration the debt. The higher the loans or the higher the liabilities of the company, the lower would the equity value be and the higher will be ROA, which is measured, divided, dividing profit to the equity. And that is why the ROAs of two companies are different. So I agree with the comments. Thank you very much for writing there. And that is the answers that we can give. Something else about ratio analysis and IFRS account. Something that we should keep in mind is that the profit margins are very important to calculate and analyze. As you saw in the previous example with the petrol company, we stopped at different margin levels: gross margin, operating margin, earnings before taxes and after taxes. That means that it is very important, in case you analyze companies, it's very important to calculate also these indicators over here. That is cost of sales to sales, marketing and sales costs to sales, distribution to sales, and administrative cost to sales. Actually, these ratios should be available from the common size analysis of the performance statement. So you already have these indicators there when you have performed the common size analysis of the income statement. You just refer to the data and you analyze how have increased or decreased, how have changed the percentage of the cost of sales or marketing or distribution or administrative. That is to understand what was the focus of the company during that specific year. Was the focus to manage the cost of sales, to manage the marketing costs, distribution, or administrative? So this is important to analyze in order to understand the overall activity. Whereas the second category of ratios was the financial status. I'm not spending much time with those ratios that we already know how to calculate. Remember, we had under the liquidity current ratio and acid test ratio. Both focus on the current section of the financial statement position. Long-term financial status, otherwise known as gearing or leverage. Usually they focus on the liability side by comparing with each other groups or sections of or items of the liabilities. For example, total debt to total equity, total debt to total assets. The second one is known as the total debt ratio, long-term debt to equity, and so on. You can actually calculate even other ratios besides what you have already there. Another ratio to include in the financial status category is the interest coverage. It looks at the cost of the service of debt. That means how much you need to have of profit in order to be able to cover substantially, with an enough coverage, the net interest costs. Even though it says net interest costs, it means the the expenses of interest over there. Another point, very important in performing financial analysis, is the focus on the cash flow statement. We mentioned that this statement is very important. It is relatively a new statement. It was introduced only a couple of decades ago, compared to the balance sheet, which has been around for more than 100 years. So this statement brings new insights in the performance of a company, and probably it should be included in the financial analysis. The problem is that till now, comparing or analyzing the performance, the financial status, or the investment potential, we did not include anywhere any indicator from the cash flow statement. So it's time that we consider how to include this important and informative statement in our analysis. So as a reminder, remember that we have information in this statement from the inflows and outflows in three activities, very important: operating, which is the main business activity; investing activities, what have we paid to have other new investments, and how much money did we get from selling those existing; and cash inflows and outflows from financing activities as well. So remember that the cash flow statement represent three categories that maybe provide information that is useful in analyzing the performance and the liquidity position of a company. So cash information is also able to reverse the effects of the accrual accounting. As we mentioned, by adjusting the different values that we mentioned, especially in the indirect method, we said that the cash flow statement actually calculates and reports items that are not affected by the accrual accounting. It just reports money that you actually received or collected, and reports money that actually you paid. So no chance of having anything fraud or by mistake reported in there. Okay? We also have this possibility that the cash information might probably tell us something about the future activity of a company. And usually it is considered, the cash flows are considered an indicator or a measure that are less probable to be managed by the companies. The earnings are usually managed and reported sometimes higher or sometimes lower than they really are, whereas the cash flows are less likely to be manageable. We had several ratios that we can calculate based on the cash flow statement. The first one is the ratio that compares the operating profit to the cash flows from operations. Now, you see that both items here, the numerator and denominator, are basically the same thing but measured through different accounting approaches. Operating profit is measured through the accrual accounting, whereas the cash flows from operations is measured through cash accounting. So again, this measure over here really represent the comparison of the same item, the same concept, but which is measured under different accounting approaches. The operating profit is measured through the accrual accounting, respecting and following all the accounting and financial reporting standards, whereas cash flow from operations is basically the operating profit adjusted to reverse and undo all the accrual accounting effects. That is, cash flow from operations is measured under the cash accounting rule. Now, how and why do we use this indicator for? This ratio, it can signal possible attempts for earnings management. Large values, well beyond 1, usually mean that we have large accruals. That means that we have at least tried to manage our accounts or to manage the earnings. Usually this ratio is required to be calculated for at least 3 years and then to see the trend of the ratio. If you see that this ratio is continually increasing over time, that means that actually the company is not generating cash flows from operations, but it is reporting continuously high operating profit. And that is suspicious for a company. If a company is really good at applying the accounting standards, usually operating profit and cash flows from operation would be comparable. And almost what is more important would be almost constant over the years. But if you notice a ratio which is constantly going up, that means that the company is increasing the operating profit by a suspicious way, while the cash flows from operations are not being increased. And that means probably an attempt on behalf of the company to manage the accounts. Okay, something even more suspicious would be when the Operating profit, remember, is EBIT. The cash flows from operation is negative. Whenever you find this figure to be negative, that means EBIT is positive and high, positive value, and positive and high value, and cash flows is negative value. Now, whenever you find this reality, this situation, please pay attention. A company that is not generating cash inflows from operating activities, that is, cash flows from operation is negative, and is still reporting operating profit positive value and sometimes high value, that is a very suspicious situation, and you should check for possible earnings management or even earnings manipulation. Have you heard about Enron company case? The Enron company, which did go bankrupt in US some 20 years ago, and it became like an example to illustrate what the financial analysis had brought into attention. Well, the financial statements of Enron company several years prior to the bankruptcy showed this ratio over here to be negative. So the company was reporting high operating profits by using the special purpose entities and hiding the losses and debts there. They were reporting high operating profit, but the cash flows were not lying. So the cash can never lie. Cash flows from operations will reveal the truth. And so this ratio is very important to understand if the companies are trying to apply accounting cosmetics or to manage the accounts, okay? So again, pay attention to the first ratio. It combines an indicator from the income statement to an item from the cash flow statement in order to make us compare accrual accounting to cash accounting and understand if the company is misusing the financial standards to hide any possible loss. Okay, another ratio that is based on the cash flow statement is the one that actually compares the cash flows from operating activities to the current liabilities. Actually, it is an attempt to substitute the current ratio. Remember that the current ratio compares current assets to current liabilities, and this ratio is often criticized because it is very vulnerable to window dressing attempts or to account management attempts. What do I mean by that? Many analysts and many financial statement preparers, they know that they would be valued or assessed according to the current ratio that they report. And so they do whatever they can, whatever is within their possibility to try to impact the current ratio value. They try to increase the current assets and so on. So the current ratio is very vulnerable to attempts to manage the accounts. Whereas if we substitute the current ratio with the cash flows from operation to current liabilities, basically we are having the same indicator, but having one item from cash flow statements increases the quality of this indicator. Okay, so this is the second ratio that we can calculate and analyze based in the cash flow statements. Vittorio is asking, only I would really require from you that any question in the chat should be to everyone, so it can be a discussion among us. Yes, that is true. What your friend is asking, let me share with everyone, because everyone might profit and understand better from this question. Yes, thank you, Vittorio. Yes, we can say that. We can say that the first ratio actually tries to reveal if we are attempting to manipulate our earnings. So hiding some losses or manipulate earnings. This is what I want to understand based on the first ratio. Manipulation of the earnings. Is the company trying to do that? So it's not easy to say, it's not only one ratio that would made it for certain or for sure that this company is engaged in earnings manipulation. We cannot say that, but that is a red flag. If you find this ratio unusually high or negative value, as I mentioned, you should check further. You should investigate why is it so. How is it possible? Usually it is not possible under normal conditions. But how is this company reporting negative cash flows and higher operating profit? Is it probably violating some earnings management, or is it violating some revenue recognition rules? So again, pay attention to the first ratio. It is important to see that in a trend, or to see over the years, not just for 1 year, because usually for 1 year we do not understand a lot. The second ratio was an attempt to replace the current ratio to increase the quality of this financial, very traditional ratio. The third one that is based in the cash flows is the ratio that compares cash flows to debt ratio. That is, cash flows from operations to total liabilities. That is actually another form or another version of the second ratio. Now, I'm not only comparing cash flows from operation to current liabilities, but I'm assuming, what if all the creditors will come and ask back their funds in the short run? Am I still able to cover the total liabilities with the cash flows that we generate from operations? Because this is the money that I'm going to generate in 1 year. Cash flows from operations. Am I still able to cover not only the current liabilities, what I'm expected to pay within a year, but if the long-term creditors, they come now and ask to be paid back, they can do that for many reasons. For example, a crisis in the market or a negative image for the company may cause the creditors lose credibility, and maybe they will come back and ask their credit loans and debts. Are we able to cover total liabilities through the cash flows from operations? So this is a ratio that reveals the potential the company has to survive in case of unusual market conditions. Because usually creditors will honor their contracts. They will not come and ask back their money earlier than written in the contract. But still, we have to take into account the possibility that this might happen. Then in these cases, to what extent are we covered through the cash flow to debt ratio? Another new ratio that we are learning today is the cash interest coverage ratio. You see that these are all new ratios that were not introduced last time, and we are going to include in the list of the ratio in Excel file later. But you can see that all of them are a kind of conversion of an existing ratio, but replacing an item with cash flows from operation. For example, the fourth ratio is the cash interest coverage ratio. It replaces EBIT with the cash flows from operation. Remember that EBIT is operating profit measured according to accrual accounting. Another more accurate measure is the cash flows from operations, which is measured under cash accounting. That is, with the cash flows from operating activities, am I able, and to what extent can I cover the interest expenses? Okay, so again, this is a ratio that substitutes, replaces the EBIT in the normal interest coverage ratio that we introduced as part of the financial structure ratios. The last one is the ratio that compares cash flows from operations to capital expenditures. Now, this is known as capital expenditure ratio. Remember that capital expenditures, if I ask you now, do you know what capital expenditures are? I think that we already, maybe we have mentioned that even before. Investments, okay, I agree, but be careful. Investments in both tangible plus intangible plus financial assets. So it's not only investments in securities, but actually capital expenditures. They involve new investments in tangible assets, property, plant, and equipment, intangible assets, trademarks, and so on, and the financial assets, which is actually the securities, shares, and bonds that we are issuing in the market. Now, what does this mean, the last ratio? What's the meaning of this ratio? What I'm trying to say through calculating this one. The capital expenditure ratio means how much we can cover the capital expenditure through money that we are generating from within the company. That means cash flows from operating activities are money generated from operating from within company. Can I cover the capital expenditure, that is new investments in property, plant, trademarks, goodwill, long-term securities? Can I buy them with the money that I'm generating from cash flows from operations? In case the capital expenditure ratio is higher than 1, this means that I can cover the capital expenditures from internal sources. Whereas if capital expenditure ratio is less than 1, that means that in order to cover the capital expenditure, I need to have outside financing. That is to finance through loan or debt. So that is, again, the new ratios that are introduced in this lecture. We are going to maintain all what we learned before, but we also are going to open a new category, a new class of ratios, and that is ratios coming from the cash flows statement. Again, we take the case of Nestle and Unilever to calculate the different ratios and to compare them. You can see that they are almost comparable to each other, except for I would stop a little bit at the third ratio, interest cover ratio over here in cash. Again, you can see that Nestle has a higher interest coverage ratio than Unilever. Remember what we said. Unilever is using many debts, many loans. That means that the interest expenditure relative to the other company are higher, and that means that the interest coverage is lower for the Unilever company. Now, do not simply compare each other the amount of interest expenditure, right? Because Unilever is a smaller company and it will have smaller or lower amount of interest expenses, whereas Nestle is a bigger company in size and will have higher interest expenses, but relatively to its profit, operating profit, it is considerably lower. That means this ratio really accounts for the size of the company and makes different companies comparable together, at least regarding their size, okay? Nestle, we see a higher interest coverage. Why? Because there are not many debts, whereas Unilever, still they have enough coverage. Remember that this ratio should be from 5 times to 8 times, somewhere in between. At least this is the value or the range that the bank requires it. And so we can see that Unilever still is able to cover the interest expenses, but the coverage is lower than its peer, its competitor company Nestle, because they operate in the same sector. Something in brief to mention about the limitation of ratio analysis, probably things that you have felt for yourself while calculating the ratios and analyzing them, but let's put them in words and let's have them clear. What are the constraints of using ratio analysis? So, first of all, is that many factors which are non-monetary or otherwise known as qualitative factors, not measured in quantitative items, they are not considered in ratio analysis. For example, quality of goods. One company may have more qualitative inventory, more qualitative merchandise than the other company, and that explains the high price, the high margin, and so on. But that is not included anywhere in the analysis through the classical basic financial ratios. There do exist some indicators of quality of goods? Yes, and they are known as alternative performance measures, and they try to account for the qualitative effects. So again, later we are going to learn about alternative performance measures which account for qualitative factors. Okay, so this is something that we are going to mention later. There are many important aspects in the activity. Sustainability impact, the impact in environment, the employees' care or customer relations. They are very important aspects of the business models and the business activities. But the basic financial ratio do not include them, do not disclose this information. So again, we are going to have another set of indicators, alternative performance measures at a further lecture. Something else that is a limitation of ratio analysis is the use of historical cost accounting. Now, remember that the use of historical cost accounting makes me account for many assets with their historical and also depreciated prices. So the use of historical cost accounting, for example, make assets appear at a lower value than they really are. Of course, the IFRS they allow the use of a fair value accounting, but for those companies that continue using the historical cost accounting, the assets will appear with a value or a cost they had like 10 years ago, and moreover, it is amortized or depreciated over time. That means that what amount they appear with in the financial statement, it's not the real potential they have to bring resources and benefits in the company. So this is also a drawback in using ratio analysis. I calculate the turnover of assets and so on, and I base the calculations in a lower than real value of these assets. Another problem is the short-term fluctuation within the year. Usually, the ratios are based at end values, at end of year values, as we already mentioned. That means that we take the amount, for example, of inventory or trade receivables at the end of the year. Okay, we try to adjust that by using the average amounts, but still, the simple average amounts are simply the sum of the opening value with the closing value divided by 2. That does not regulate for the fluctuations and differences in an item that is happening within the year. So this is something that we should also want to take into account. Actually, what is usually been doing about these short-term fluctuations is that in real life analysis, when you are internal analyst in company, you usually base your calculations not in simple average values, beginning of year plus end of the year divided by 2, but in, let's say, more complex averages. That is, the end of each month added together divided by 12, which is the number of months in a year. That would make up and reveal for any short-term variation in the activity of a company. Again, this is not possible to do and to disclose in a simple external analysis that we are undertaking for the purposes of these studies, okay? And the last one, limitation, is the changes in the value of money or the inflation rate. Of course, we have inflation rates under control all over Europe for many, many years over now. But be careful when you analyze companies that may have some subsidiaries or other companies that operate in countries that have had really huge inflations. For example, Argentina 15 years ago or Venezuela like 3-4 years ago. So be careful about the time and how that affects the value of money. So again, ratio analysis is not perfect. It has some drawbacks. You have to consider the context and so on, but you also have to consider the qualitative factors the use of historical cost accounting for those companies that do not use the fair values, short-term fluctuations within the year that are not captured and revealed in the end of year figures, and also the changes in the value of money. These are all factors that should be kept in mind. The last thing that I wanted to mention is in your textbooks, but we are going to explain and make required only one of them. The first one is the multivariate analysis regarding the bankruptcy prediction. The univariate analysis is that kind of analysis when we are basing our calculations in only one ratio. That means that we calculate the current ratio, we interpret that. We calculate, for example, the total debt ratio, and we make a comment on that. But these may differ and tell different tales for the same company. We may find a beautiful story told by current ratio, whereas when we go with the debt position, we do not see the same positive results. That is, that it is difficult sometimes to combine together the results of different ratios when we perform univariate analysis. Again, what is univariate analysis is when we analyze, is when analysis is based on one ratio at a time. One ratio at a time means that I am taking them one by one, calculating and interpreting. And this is very wrong because sometimes it does not help to capture the real truth. That means that we have to combine several ratios together. And if we combine several ratios together, we can calculate a score, and this is known as multivariate analysis. Of course, different ratios are assigned different weighting factors. Now, which ratios to combine with what weightings to assign to each of them, this depends on empirical research. So again, multivariate analysis combines many ratios. You have seen that we have probably more than 20 ratios altogether. Which of them to take and combine together? And what weighting to give and to assign to each ratio? That is not decided theoretically or academically, but it is decided based on empirical research. That is, researching the market, researching the financial statements for as many companies as you can, as many years as you can, and then drawing some conclusions and coming up with a score that represents the combination of ratios and their weighting factors. Okay, so multivariate analysis has been used mainly for two purposes. The first one, to predict the bankruptcy or to predict corporate failure, very interesting empirical research. And the other one is to determine and to find out if the company is actually manipulating its earnings. We mentioned one ratio about that, cash flows from operations to, operating profit to cash flows from operations. But what if we also consider the possibility that other ratios can say something about the manipulation of the earnings, and actually these are ratios that assume the accrual effects. So again, multivariate analysis has been widely used in practice in empirical research into two different fields, bankruptcy prediction and earnings management. Let's have a look at the first one. There are two well-known models, that is Altman Z-score. Altman has used a multiple discriminant analysis, MDA. This is the technical tool that he used to come up with his Z-score, which is famous. And also several years later, Altman is from 63, I think. Several years later, Olson, he introduced the same multivariate analysis, but using another statistical technique, which is probit, or this is the calculation based on probability of happening, or what is not only calculating a score, but what is the probability of actually being bankrupt. This is the technique that Olson used. Even though the technique of Olson model was superior to that of Altman's Z-score, Altman's Z-score is the most famous one. is still being taught in several business schools. So this is one that I'm going to include in our course, and I'm going to require that. So this score is from 60s, as I said, and Altman original model was based on the US manufacturing companies. That means that outside this data set, probably the model will not be true. So outside of the 60s, outside of the US manufacturing companies, probably the z-score model will not be this, but still we are just trying to illustrate the calculations here. Altman is a professor of financial accounting at New York University, and he calculated the z-score using the multiple discriminant analysis, and he came up with a score that combined 5 ratios together. The 5 ratios are over here. Working capital to the total asset, the ratio X1. X2 is retained earnings to total assets. X3 is earnings before interest and taxes, that is EBIT, to total assets. X4 is market value of equity to total liabilities. And the last one is sales to total assets, or how we know that, the turnover of total assets, okay? So if we calculate these 5 ratios and we put them together in an equation like that one, that it's over there, you will have the z-score measure for that company. This is the use of multivariate analysis, so the combination of different ratios in order to come up with a decision. Okay, we have a question that we can take. Can we calculate, thank you Valeria, can we calculate ratios without transforming them in percentages? Yes, you can express them in times and then apply weightings like 1.2. Good. So be careful how you express the ratios. I think that in Excel file I have mentioned the format of ratios and how to apply the coefficients over there. But yes, in case you do not represent them in percentages, but in time, so working capital to total assets is 1 time, for example, then you calculate or apply that with a 1.2 coefficient. That is correct. Okay, so if we continue, Altman found that for z-scores higher than 2.99, the company is not likely to go bankrupt, whereas lower than 181, the company will go bankrupt. The area or the range, the interval between 1.81 and 299 is what is known as the gray area, something that we really don't know what the future will bring. Probably the company is in the risk position and probably it will become bankrupt in the future, okay? So again, another model for multivariate analysis is for earnings manipulation. This is optional. I think that I wrote in the slides, but Binish model is optional for you. You are not going to be asked anything in the exam about the Binish model, and you are not going to be required to include that in your group work project. But still, if you want to read more, just ask and I can provide more information. It is very, very interesting. Binish is another author, is another researcher from US, and actually he tried to combine together several ratios to pinpoint and identify those companies that were trying to manipulate financial statements. Okay, so the M score is this one. You can see that it is longer and it includes more ratios. This is why I'm not wanting you to learn about that. The ratios are over here: day sales in receivables index, gross margin index, asset quality index, and so on. Every one of these ratios is explained in the textbook, and each of them you see is appointed a weighted factor. When we combine the M score, sorry about that. Do you still see the PowerPoint presentation? By mistake, I pressed HTML link. Okay, we can still see that. So if we calculate the M score and we find the ranges and values that are represented there, then we can decide if a company is a likely or a probable manipulator or not. So again, try to apply the Binish model and to calculate the M score, but this is something that is not mandatory, is not required for you. It is an extra question, and as I state in this slide, okay? Binish model, not to be included with exercises and calculation in the exam. What you are expected to know, it is only the use and the purpose of the model. So what it is used for, what does it want to state and bring out. So at least you know what the Binish score is, but the technicalities and the ratios that are included in this model, we are not required to know. The last items that I want to go through very quickly is the disclosure of non-financial data. Why I say very quickly? Because the non-financial data will be covered altogether with alternative performance measure in a further lecture. So we know that key performance indicators in relation with the customer satisfaction, environmental performance, employee data, internal business processes, and learning and innovation, we are going to cover them later. Why? Because usually these are qualitative factors. They are not quantitative. They are not expenditure, income, or assets. So I cannot include these factors in the key performance indicators of the basic financial ratios. That means that I have to introduce some alternative performance measure, and this is what many companies are doing in the recent years. So again, what you should do for the group work and presentation, you can see that you have to include a trend analysis and common size analysis for both reporting years, but only only for those items that I have extracted in the Excel file, okay? Don't go over that. It will take a lot of time from you to analyze all financial statements, trend analysis and common size analysis, okay? So please don't do that. Calculate and comment 5 ratios which are based on the cash flow statements. They are the new ratios that we introduced today, okay? And then the last thing that you should do is to calculate the z-score for both years and to interpret and to comment on the importance of that indicator. Remember, this score is generated by an empirical model many years ago in a different context from the European companies that you are analyzing. So just try to calculate it, but when you interpret this indicator, be careful to be cautious and to have very attentive to be very attentive, sorry, to the details. Okay, so we have some more minutes. Please have some patience. I know that we are going to meet each other also in the afternoon, but later we are going to upload this Excel file in your Moodle platform. So I want to make sure that you understand what it is included there. In this Excel file for today, we are being based in another company. We are not talking about Carrefour anymore. So what we are talking about here is the Peugeot company. Data is in millions of euro. We use this sheet over here to perform vertical and horizontal analysis, okay, of all the information that was important for the ratios. Now remember, we are not taking full financial statements into account, just the items that we need to calculate the ratio, okay? So again, what you have in this Excel file is the same structure. In the first sheet, you will have all the formulas represented, but be careful, the list of the formulas now is enriched to include, sorry, I just want to give you an overview. The last items that we are introducing is the cash flow ratios and the z-score. So the new ratios that we mentioned today. The operating profit to the cash flows from operations. And what does it mean? In the comment cell over here. Cash flow to short-term debt ratio. And what does that mean? It aims to substitute the current ratio. Then we have the cash flow to debt ratio and the meaning in the comment section. The cash interest coverage ratio, it substitutes the EBIT in the normal interest coverage ratio. And the last one, the capital expenditure ratio over here. Whereas by the end of this sheet, you have the risk ratio, that is yet another category that we can mention, for example. And the risk ratio is only one. We are dealing only with the z-score, Altman z-score. No mentioning of Olson model or the Binesh model, okay? So you have the formula, sorry about that. Can you still see my Excel file? Okay. Can you still see the Excel file, please? I lost it. I pushed something. Okay, thank you. So we have some questions. Thank you very much. Yes, that is correct, Adela. For this score, we have to use this formula here, and that is x1 multiplied by 0.012 and so on. So this is the formula, and as I promised, the formula is also going to be illustrated later. That means each of the ratios included in the z-score is calculated according to these formulas. Okay? So this is the formula that we are going to apply later. Again, these are the formulas. The second sheet of the Excel file is the data. You can see that the data is almost the same. Basically, the most important information comes always from the income statement. Then we have some extracted information from the statement of financial position, only those items that are necessary to calculate the ratios. Other data that we include is, except for the number of shares, dividends, and market price, you see that we have to include over here, in order to be able to calculate the new ratios from cash flows and risk ratio, we include some other information. Cash flows from operations from the cash flow statement. Capital expenditures. I have put in the comments of each cell how to find this item. You go to the cash flow statement and you calculate the acquisitions or the purchases of new investments during the year. Retained earnings, usually you should go under the item retained earnings at the statement of changes in equity to find this item. Whereas the market capitalization, you know that it is the product between the number of ordinary shares and the market price. So again, market capitalization is the total market value of shares simply multiplied number of shares to the market price per share over here. If you combine these two together, you will have the market capitalization. So this is the data. In order to help you orient in this, I also copied and pasted an extraction of the income statement just to let you see. Okay, we performed the vertical and horizontal analysis. We already did that for the most important information, and what I already prepared beforehand in order to don't lose any time right now. In the last sheet, you have the ratios, starting with the performance ratio from one year to the other, okay? So you have them calculated. Of course, you will have a look at all those ratios that have a very declining and disturbing trend. For example, all the return ratios are decreasing. ROCE from 12% to 7% and so on. So this goes in line with what we said, that this company is experiencing a very low level of activity in 2020. Okay, so again, you would like maybe to comment on the ratios. You can see something. The increase in the current ratio goes in line with what we mentioned about having many cash and cash equivalents. Remember that Peugeot had almost 1/3 in cash and cash equivalents, and this is a representative increase as well of the current ratio, and so on. You can comment on yourself for the ratios. I would like to stop at the new ratios for today. Cash flows ratio. Here you have calculated all of them from one year to the other. And also the last one, which is more attractive, is the z-score. Now you know that the z-score is based on 5 different ratios. They are both calculated over here according to Excel formula and the sheet data, if you can see, and they are combined with their specific coefficients in their respective cells. Now you see that the Peugeot company in both of yours, I think it's in the bankruptcy zone. But remember, whenever it's good to learn how to apply and calculate the z-score, but regarding the interpretation, remember that the z-score relates to manufacturing companies in US in 60s. Now we are manufacturing and selling company all over the world and in 2020. So probably the interpretation is not right, but still we have a decrease in the value of the z-score, and that probably means and reflects the decrease in overall activity in 2020. Okay, any questions so far to what we have over here? Again, this Excel file has everything calculated for Peugeot company. I will upload this in Moodle and you can use for your own companies. Probably you started to calculate everything until investment potential. That means that you just add the last section. But in order to add the last section, you need further data. And where to find this further information, other data over here, you have everything written in comments, okay? So I think that would be helpful. Any questions? In case you are all clear, I would finish for the moment, and then we will meet again at 2 o'clock to have a tutorial about the earnings per share. So a little bit change of what we are talking these 2 last days, but remember, questions and tutorials and exercises regarding the ratios we will have next week when we will all meet in class, okay? So goodbye for the moment and see you in 2 hours.